Venu Krishna, Barclays head of U.S. equity linked strategies, joins us this morning. Venu, good to have you back. As we were saying, we're all bracing for some numbers that we hope are not warm. What kind of risk do you see embedded in stocks right now?
I think the risk first primarily on the valuation side, because I wouldn't call them rich in aggregate, but they are quite full. And so they are very sensitive to the move in rates. So to the extent that rates are below 4.5%, I think we're in a good zone where growth is decent, inflation is contained, the Fed is vigilant, and things are good, and nominal earnings are going to be strong. But I think once you cross that 4.5 threshold and you start heading closer towards 5, the negative correlation of equities to rate movements kicks in clearly, and that is showing up, like you were just discussing, in the term premium, in the move higher up in rates, and concerns about inflation being sticky or, in fact, even inching higher. So I think that is the principal channel. On the other hand, the good news on earnings, things look quite decent, and actually they should pick up compared to last year, though the components of that varies quite a lot.
We mentioned the phrase unusual seasonality, attributing it to you. What do you mean by that? What's unusual about it?
Yeah, so typically what happens is, you have the fourth quarter, which ends up being quite strong, and the first three, compared to the first 3 quarters. Last year, we were opposite of that. We had extremely strong first 3 quarters. We never saw a Santa rally, really, in Q4. And Q4, compared to its history, was kind of on the weaker end. Typically, what that suggests that Q1 is kind of flat to down. We'll have to see how that plays out. But seasonality right now is not in the market's favor.
Finally, come inauguration and day one of the new administration, there's reports of maybe dozens of executive orders and policies being unleashed. The market's going to have to absorb all of that in a hurry. How will that make at least the month of January challenging?
Very challenging, right? Because with the new administration, there are 2 opposing forces. On one hand, you have the pro-growth policies, which the market has increasingly focused thus far on lower taxes, especially, for example, and less deregulation or less regulation or deregulation. On the other hand, the risk which has been underpriced is the impact of tighter immigration, especially, for example, in the markets, and tariffs. So I think there's a big debate. Obviously, there are a minority of economists who actually think that tariffs are, for example, going to be positive, but a majority of them are concerned about the inflationary impact and the negative impact on growth. And clearly, the inflationary impact will show up in term premium like it is right now.